Disclaimer: the insights and opinions shared on this show are for educational and entertainment purposes only. Before making any financial decisions, we recommend consulting with a qualified professional to better understand your unique financial situation. Welcome to the Investors Playbook Show, where our mission is clear: empowerment through financial education. We firmly believe that financial freedom isn't a privilege, it's a right that's available to everybody. Each week, we dive deep into the world of finances, breaking down complex topics and making them accessible and actionable for everyone. As we grow this community, we invite you to join us on this journey. Why tune in? Because together, we're not just learning about wealth, we're building a movement, reshaping futures, and proving that with the right knowledge, financial success is within everyone's reach. It's time to get off the sidelines. Let's go. Yes, sir.
All right, Investors Playbook, episode 19. I'm Cornell Rowan.
And I'm Deshawn Edwards, and we have our first episode of 2024. Cornell, how do you feel about today, man? How has your 2024 been so far? Talk to me, bro.
I actually feel great about today, man. You know, on the weekend I hit the gym, and then I come here. I got a little routine, man. Hit the gym, get coffee, come back to the house, and prepare for the show.
You know,
Um, what's up?
so I'm just thinking, it's so funny, bro. I remember when you used to not jam with black coffee, and you had to just try it one time. You were totally against it.
It's
Remember
funny because it wasn't just one time, and that's why, like, I've tried black coffee and I didn't like it. I think it's like an acquired taste, kind of like beer. You
that?
know, the first time I drank beer, I didn't like it.
Really?
Yeah.
I'm
So the
trying to.
first
I don't
the
know if
first time you drank beer, you just automatically liked it?
I don't remember, bro. I think, but you got to realize the first beer we used to drink was like Bud Light, and
No, that was the first beer I drank with you all. You
oh,
see what
so
I'm
what's the
saying?
first beer you drank?
I want to say it was probably Corona, my dad.
Okay, okay, that's why you like Corona so much.
Yeah, that might be. But what about you? How you feeling, bro? How you feeling?
Bro, I, I'm excited about 2024, man. Like this year, um, it's funny because I've been since the beginning of the year, everyone has those New Year's resolutions: go to the gym, go to the gym. Bro, I've been going to the gym and it's been kind of empty, bro. Like it has not been. It's not my normal. When I go to the gym at the beginning of the year, is packed. It's been very. It's either been regular or less people than normal, and I'm like, is this the year that people, everybody, like that? Is this the year that people decided, you know what, bump them fitness goals? I don't want to. I don't want to try it anymore.
I think it depends on what gym you go to, man. Because mine is crazy packed. What gym do you go to?
It was LA Fitness. Maybe it was the
Oh,
time.
that's
Maybe it was
crazy.
the time. Maybe it was the time. I go early, so maybe that's what it is, bro. Maybe the time. But I know, yeah, that's probably it. But your gym is more packed than normal beginning of the year. Like,
For sure. I made a video and put it on my IG. I'm talking about the whole parking lot was packed.
sheesh.
It's pretty bad, man. So I guess it
Yeah,
just depends on where you are.
it depends on where you are, and then because out here there are tons of gyms out here too. That's another thing. Like, it's not just LA Fitness that people go to. So maybe a more popular gym has more people going to it. Who knows? I don't know, but
Yeah.
it's,
But
yeah,
as Ashan's talking about New Year, New You, there's also new financial changes, right? And that's
yeah.
what we're here to talk about today. Just with new contribution limits to things like the 401k, your IRA, your HSA, and
Hmm.
even the new tax brackets. So we wanted to take the time to fill you all in on the changes that we researched, of course.
Yeah, yeah, and I know a lot of people. Um, these numbers are important. I just want people to, first kind of take note of that as we go through each of these numbers, um, and we explain, the increase from this number to that number. A lot of this is happening because the government, or whoever decides to make these changes, they recognize that life is not getting easier; it's getting more difficult. So these increases are supposed to help people, right? Help people put more money towards investing. So, like we always say on our episodes, you got to take advantage of these changes as they happen. If you're able to put more money into your retirement, put more money into your retirement, because you're allowed to put more money into your retirement now. When we started our retirement, I think the limit was 5,500, something like way back when. Like it's
I
been
can't even
increasing.
tell you, man.
It's been
Yeah,
increasing steadily every year almost, because things have gotten increasingly more expensive. So yeah, like Cornell said, we're gonna go through all these. We think that it's very important that everyone knows this information, because as they plan out their 2024, you want to know your options. I think I mentioned that in the episode previously. You got to know what your options are. Go ahead, Cornell.
for sure. And this is not just for people who invest, because these numbers, like the standard deductions, they also they affect everybody. Everybody in their taxes, unless you are itemizing, of course.
Right.
So yeah, I think we should jump into it, man.
All right.
I know the first thing that I wanted to bring up, the one that's the most common that pretty much a lot of people do, even if they're forced to do it, or not so forced. You know, a lot of people do the 401k, 403b. And I think first that we should explain the difference, because people, when they hear it, they just hear these numbers, right? It's like, okay, 401, 403, but what does that actually mean? So
Mm-hmm.
basically, they're the same thing. They're the
Yep.
same thing. They're just tax codes. And 401k is for profit companies, and a 403b is for nonprofit companies. So if you're a teacher or something like that, you would typically have a 403b if you have a retirement account other than your TSA. And if you work for like Target or Walmart or something like that, you would have a 401k, because you are part of a for-profit um, establishment or place of employment.
Yep.
So let's get into the limits. Did you want to?
Yeah. Yeah. For sure. So last year, the amount of money you can contribute to your 401k, and remember, we always talk. Well, I won't even keep saying we always talk about. Remember that as you're contributing to your 401k, one of the benefits is that you, a lot of times, can get an employer to match the amount of money you're putting into your 401k. So, for example, the if I'm putting in 8% of every paycheck, my employer matches 6% of that same amount. That is literally free money. But that, again, the limit that you can put in your 401k is now $23,000. Last year it was 22,500. It increased $500 to, again, 2024. You can put $23,000 into your 401k. And I want to make sure that you all also understand that this does not include the amount of money that your employer is matching. You can put 23,000 of your own money and they will match, depending on however your employer matching works. They will match the amount that you put in, and it depends again how your employer matches you, how your employer matching works. But the main thing is the limit has increased by $500. So now for this year, for 2024, you can put $23,000 into your 401k. And again, a this is not putting 23,000 at one time into your 401k. This I mean, it could be, but this is more so you putting in that amount of money over the span of this tax year. So starting now all the way to December of this year, the end of this year, the goal is to try and max that out, that 23,000. And you can break this up into paychecks. Again, we talk about automation a lot. But yeah, the main takeaway is that the increase has increased by $500 for your 401k, for your 403b. And this does not include the amount of money that your employer matches.
And what I always tell people is, when it comes to retirement, this is the most important form of putting into your retirement, because of the fact that you were getting that instant return on your money. So say you're putting in 8% and your company matches you 8%. That's automatically 100% of what you're putting in.
Mm-hmm.
In
Literally.
no other investment are you just going to make an automatic 100% and double your money like that. If you
Mm-hmm.
put money into a Roth IRA, do you know how long it's going to take for you to generally get to 100%? That could take that's probably gonna take years. If 5 years is a good amount of time to get to 100%, but here you're getting it instantly. That's why I tell people this is always the best form of saving for your retirement.
Yeah.
The number one.
Exactly. I mean, it's free money.
The
Essentially, it's free money. Um, so with the 401k, 403b increased limit, that's not the only retirement account that has increased, right? If you, or even if you do have a 401k, but if you don't, if you aren't working for an employer, you don't have a employer match, um, there's an individual retirement account that you can open. Not to say that if you do have a 401k that you can't open an IRA, but IRAs, that limit has increased as well. So last year it was $6,500. It has now increased to 7,000. So another $500 increase. We're talking traditional IRA, Roth IRA, whichever one you have. You're not able to contribute $7,000 a month. And similar to the 401k, you can do monthly contributions. You can do like my man Cornell did and put the whole 7,000 in at once. It's up to you. You know what I mean? It is up to you. However you want to slice this pie, but try and make it a goal to start hitting those limits because all it's going to do is set you up for the future. I think 7,000 divided by 12, what is that? Like 580 something dollars a month. $583 a month. You put $583 a month into your account, by the end of the year, you'll hit 7,000. So that's the easy way to cut it. Go
man,
ahead,
you
bro.
know you put that into a calculator. Ain't no way you just did that in your
Quick
head, bro.
math, bro. Quick math, bro. Quick math. What you mean?
Ain't no way. This man was like, "What is that?"
Quick math.
Five
Quick math, bro.
hundred. I'm like, bro,
Why
ain't
you
no,
hating on my computing skills, bro? What you
bro, ain't no way you just did
mean?
that.
All you gotta do is carry the one, bro. You easy. No, I'm just playing.
Oh
Nah,
man.
but for real though, yeah. So $7,000, 583 a month roughly. And oh, I guess I should have mentioned previously. I forgot to talk about the catch-up limit for 401k, 403b people. Cornell, I know it's 23,000 if you're under the age of 50, but if you're over the age of 50, it's a different limit, right?
Yes.
Yeah, I forgot to
So
mention that.
so that limit last year was 30,000, but now it's up to 30,500 for
Mm,
the 401k 403b. So the catch up limit for the IRAs are is 8,000. So it's an
mm-hmm.
additional 1,000 compared to the 7,000 that everyone else can do if you're under the age of 50. And I know that Sean mentioned that yeah, on the first business day I usually max out my Roth. So there's a reason for that, is because time in the market is more important than time in the market. So what I do is I try and hit it early so I can get all those gains within the year.
Mm-hmm.
And
If I could,
I'm
if
sorry.
I could ask real quick, when you did put that in there, what did you decide? What security did you decide to put it in? Did you spread it out? Did you put it all in one? Did you hit some single stocks, bro?
I hit no single stocks. I typically don't do single stocks inside my retirement. I'm in a
Makes
lot of single stocks outside of my retirement, but I put it in the queues, man.
mm,
QQQ, because AI tech I feel like it has more room to grow, especially with AI
yeah,
going on. Man, the sky is the limit right now, and I feel like this is, I wouldn't say ground floor, but I don't feel like we've even reached the full potential of AI, and it's
right,
becoming more normalized in our everyday lives. All these big name companies, really all of them,
right.
Microsoft, Apple, Nvidia, Google, Amazon, all of them are heavily invested in AI, and big things are about to happen. So I feel like the Qs are the best way I could have invested that 7,000. in my
Yeah,
Roth
that makes it.
here.
The Qs, that's the Nasdaq, right? Like that's the. Is that how the Qs work? Because I know you have like the SPY for the S&P 500.
It's tech, yeah. So it's
That
not specifically the Nasdaq, but yeah, they're very similar. Yeah, because the
okay,
Nasdaq is tech also. So very
gotcha.
very similar.
Okay.
All right. So in addition to that, man, there's actually something I just found out today. There is actually a limit to how much you can make to write off the contributions to a traditional IRA. Did you know that?
No, bro. Like when we were doing our research for this, we both learned that for the first time because that's one of the things that we've always said was a benefit of a traditional IRA, right? Or
Right.
as a traditional IRA, the money that you put in into a traditional IRA, you can write off. But now we're learning that there are like if you're making a certain amount of money, that doesn't apply to you, and that amount is kind of small, bro. To be honest with you,
It is. So it was very surprising to me, and what I'm trying to figure out is if you're over that limit, what is the point of even using an IRA? You might as well have a regular brokerage.
yeah, I think I don't know because at that point you you can't write off for a traditional IRA, and then you get to a point to where you can't contribute to a Roth IRA. Then you're forced to do a traditional IRA. Maybe the only other thing I can think of is if you've maxed out your 401k. No, you're right because there's still no tax benefits.
There's
It's
no tax
just
benefits because if I'm not able to write off what I'm putting in, where's the tax benefit? Because it's not at the end because you're going to get taxed on your gains. See, this
hmm,
is a question that needs to be researched because I don't get it. What would be the point of me putting it into this account that I can't touch until I'm 59 and a half when I can just put it into a brokerage that also doesn't have tax benefits?
yeah. After you've reached a certain amount of income, I don't know. We gotta research that one,
And,
man. Cause
and maybe that's intentional. Maybe because before now, people have been doing these backdoor Roths, right?
yeah,
Where they
hmm,
would put money into a traditional IRA, get that tax benefit, and then they would
roll it
roll it
over.
over into a
Hmm.
Roth. But now, if you were to do that, if you put your money into a traditional IRA, you're not able to write that money off. And then if you roll it into a Roth IRA, you're going to get taxed again. You get what I'm saying? So
Yeah,
yeah, maybe they did that to
from doing
avoid
the
people doing that.
backdoor stuff.
Yeah, that would make sense because at first, because that's actually a loophole.
Yeah,
Because when they cut off the Roth contributions, they mean for you to not use a Roth.
right.
But people
But
are
we'll
using
still
this.
do it
Yeah,
by doing the traditional rolling it over. Yeah. Hmm.
yeah.
Maybe there is another benefit of a traditional IRA that we aren't seeing because right now it puts your money in a spot to where you have to meet qualifications to even pull it out. You don't get a tax benefit after what is the number 77,000 or something.
So there's a phase out range. The phase out range is from 77,000 to 87,000,
Okay, so after 87,000 you no longer can write off your contributions to your traditional IRA.
which is crazy. I think that this is a new stipulation because I don't remember this in previous
Me
years.
neither.
So I'm thinking it's a way to cut out that loophole. But I'm not 100% sure that these are just my thoughts and opinions.
No, yeah, I got you. Yeah, that's interesting though, because yeah, you're right. At that point, it's like, what are the benefits of
The
a
benefit.
IRA? If you can't do the Roth IRA, if you can't do the Roth, you can't write off the traditional because that's way lower than
Right.
the Roth IRA. So mhm.
It's
maybe we'll have a special spinoff episode where we talk about our IRAs. Like after you're making a certain amount of money, our IRAs even you know a
right.
resource.
Do they even make sense?
Yeah,
Right.
yeah, interesting.
Yeah.
Um,
So for married couples, for the traditional to deduct contributions to a traditional IRA, the cutoff is 123,000. Well, the phase out range is 123,000 to 143,000.
Okay.
Yeah.
So married, as long as you're combined making less than 143, you start to phase out 121. But before that,
123. You phase
123,
out. Yeah.
43. Okay. You can deduct everything you contribute up until that point. And then of course, I guess it's stair steps, lower and lower and lower. I don't, yeah, the numbers of how much you can contribute. That's when you're gonna have to talk to your financial advisor, see
Exactly.
exactly, how much you can write off. I didn't mean to say contribute. How much you can write off as you contribute to your traditional. So
Right.
okay, yeah, man, yeah. I've never heard of that either. So it might be something that's newer. I don't know. We got to look into that and see. Um, but we also mentioned. Oh, go ahead. Go ahead.
So next we have the Roth. Is that the direction that you were going in?
Yeah, I
All
was
right.
about to
So
mention.
there's actually an income cap that you can make in order to contribute to a Roth IRA. So a Roth is my number two. You know how I said 401k, 403b match is number one? After you finish meeting that match for your employer, I'd say Roth is my second option, because the beauty of Roth is that you're putting after tax dollars in it, and then when you hit 59 and a half, whatever that money grows to is yours. It does not get taxed again. That's huge. Okay. Because say you have a traditional IRA, right? And let's say it goes to $1 million. And let's say you take it out. So and you want to take it out all at one time, right? You're going to be taxed at almost 40%. So $400,000 of that a million is the government's. Is going to the
Right.
IRS,
Yeah.
right?
Yeah.
If you have a Roth, you make $1 million, which is highly possible. I'm not just throwing out some number that's
Right.
not attainable. $1 million is highly possible, especially if you're putting into a Roth consistently and you're
Mhm.
starting at a younger age. It's highly possible. So let's say you make $1 million in your Roth and you want to take the whole $1 million out when you're 59 and a half. You can do that. And guess what? The $1 million is all yours, no taxes,
Right. But
because
see,
that's the
this is why
tax.
you got to start. This is why you got to start early because, as Quinn mentioned, there are income limits to this. So after you hit a certain threshold of income, the Roth is cut off. You can't contribute to it anymore. You are forced to contribute to your traditional IRA or you're stuck with your 401k, 403b. That's why you need to start contributing to your Roth as early as possible. Now, those limits are increasing, or they have increased this year from last year. But again, it's still a cap. It's still, after you hit this amount of income, you are no longer able to contribute to a Roth. So contributing early and often is super important. What are the new limits though this year, Cornell, or the
All right, so
new range, I guess?
the new range will phase out range and limits. So
Hmm.
if you're single, it's 146,000 to 161,000. That's the phase out range. So after 161,000, you are unable to contribute to a Roth when you're single.
Hmm.
And for married couples, the phase out range is from 230,000 to 240,000. So for married couples, if you're making over 240,000, you are unable to contribute to a Roth IRA.
Right. And when this number we're talking about, right? This will be the net profit that you've made the previous year. I'm just I just want to making sure that I'm correct with that. So you were talking about, let's say this 161,000 is the cutoff limit for Roth IRA. I'm comparing that number to what my 2023 taxes said I made in 2023. This includes deductibles. It includes if I, decide to do write-offs, whatever that net profit number is, that's the number that I'm using to compare. So, like say your salary says you're making $180,000. You have the standard deductible, or you decide to do write-offs. You're 183. You brought it down to whatever number because of the amount of write-offs. That's the number you want to look at is what I'm talking about. Like the net profit. Don't
You
just go ahead.
you're right. Is your adjusted gross income. So it's
Yeah,
your gross income minus the deductions that bring your taxable income down. You're absolutely right, bro.
yeah, yeah. So look at that adjustable gross
Mhm.
income
Right,
when you're trying to figure out how much you can contribute to your 401k, your IRA. Don't look at your salary. Look at your adjusted gross income. That I just want to make sure people understood that number too. So you won't know your adjusted gross income until you file your taxes
right.
this year for 2023. Um, but if you know that it's gonna fall below these numbers, start contributing now. That's just start contributing. If you know that your AGI is gonna be below 146,000, or if it's gonna be below 161, because again, it's stair steps. You can still contribute to a Roth IRA if you make less than 100. If you made less than 161 in 2023. So don't wait until April to start contributing to a Roth IRA if you can contribute now. So
Right, because then you'll be playing catch up and it'll be harder to max it.
exactly.
And the goal is to max it, but just do what you can. Something is better than nothing. Just because you feel like, oh, I'm not going to hit $7,000 this year, doesn't mean you shouldn't put anything in there. Something
Right.
is better than nothing. Okay, so
Exactly.
even if it's $50 a month, that's still better.
Something.
All right, that still
Something.
equals out to $600 a year.
Right.
You see what I'm saying? And it's not just you putting your money in there. That money is also gaining interest from the market. So
Mm,
that growth is still important and it's tax-free growth. So remember
right.
that.
Exactly. So yeah, man, we regardless of what the limits are, we want to just make sure that you are aware of where to put your money, where you can't put your money, and just start now. Like start putting your money into something. If you have a job with the 401k, talk to the individual who helped you set up your 401k so you can adjust the amount of money you're putting in there. If you don't have a 401k, open an IRA. Everyone can open an IRA. Literally everyone can open an individual retirement account. You can have a 401k, you could be an entrepreneur, you can open up an IRA and get some of these benefits, right?
And half the time, you don't even have to talk to the person that set it up because I know with us, I don't know if you remember, bro, but when we first started um our IRA. They put us in some type of freedom fund where it adjusts as you get older and it gets less and less aggressive. Which
Yeah,
in theory it sounds good because the closer I get to retirement, the less aggressive my stock should be, right?
right.
But when we compared it to other mutual funds, it didn't even come close. And it was
No,
your aunt that actually showed us a how mutual funds should be performing.
I
And we were
remember
like,
Tracy
yeah,
showed us. She showed us that. I was like, "What are we
what are
investing
we
in, bro?"
doing? What are
Because
we
she had a
doing?
mutual fund that had performed crazy. I remember that.
And the thing
Yeah,
is, it wasn't even so crazy. That was how mutual funds were normally performing then. You see what I'm saying? So
ours
we
was just
found
underperforming. The ones we were in were just heavily underperforming. Yeah,
because we got into something that somebody else just told us to. Yeah, they're professionals and they're supposed to lead you the right way, but at the end of the day, you have to do your own research no matter who you're listening to. I don't care what qualifications they have. You
right.
have to do your own research because if we had just listened to that professional, that licensed professional that put us into a fund, we would be severely under the net worth
Yeah,
that we are now,
right.
just because we didn't look ourselves. It took someone that is not a licensed professional when it comes to selling mutual funds and things of that nature to let us know, hey, there's better out there. So Deshawn and I took it upon ourselves to go on Fidelity's website. We looked at the mutual funds, we looked at the tool, we looked at the hypothetical chart, and we compared mutual funds. We said which one is performing the best
Yeah,
this year.
we
You
looked
see what
at
I'm saying?
history of multiple, and I'm telling you, these apps make it so easy for you to look at. You can like literally compare them one to one to one. Like, okay, this did this year. The past 5 years, it did this growth. It tells you exactly what stocks each one is invested in. like all the information is right in your face. Like in Fidelity, we talk about Fidelity a lot, but that's kind of where we started our big growth. You know what I mean? We had a couple of ones before, but Fidelity is the one where we started using that heavily. That's where we opened up retirement accounts, brokerage accounts. So, and Fidelity has a very good, user interface. So, um, yeah, I think that, and the same thing with 401k, not just your IRA, but with your 401k, you have to make sure that you're looking at what your 401k is invested in, because I'm telling you, it's a lot of people that I talk to who are in those same, I don't know what they call, like time funds or something, or
Yes.
retirement time funds. They'll have a number
Yep.
associated with it, which means the year that you plan on being 59 and a half. Like it'll be 40 something 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 or
Yep.
45 something something something. That's your retirement year. And those funds adjust as you get closer to retirement age. But I mean, there are so many better mutual funds out there. So many better mutual funds. So, like Cornell said, just do your own research. Make sure that you know what you're investing in. Don't take blind advice. Take advice, but take it with a grain of salt. Make sure that you actually understand where your money's going. How is it growing? And take a look at your investments regularly. You don't have to look at it every day. You don't have to be a trader, but maybe, twice, at least 4 times a year, like once a quarter, look at your retirement account, see how it's performing. At least once a year, look at your retirement account, see how it's performing. Because adjustments can be made really quickly. You can easily shift what your investments are, and a tiny shift in what you're investing can change your future drastically. Like seriously, because you're putting money into this 401k almost every paycheck, right? Thousands of dollars every month, depending on how much money you make. So
I'm pretty sure it's every paycheck. I know that's how my 401k. If
no,
you're,
yeah,
yeah,
it's every paycheck.
every paycheck. Yeah. And my
Hmm.
thing is with something so important, because what you have to realize, this determines how you're going to live after 59 and a half.
Hmm.
With something so important, do you really want to put that in someone else's hands?
Right. Why would
Would
you
you
want to?
would you just put your life in someone else's hands and just be like, do whatever you want? Just control whatever I do. Like who would do that? You see what I'm saying? Our freedom is probably the most important thing we have.
Exactly.
And why would you just give that away? You're putting your retirement in someone else's hands.
Yeah. Get out the sidelines,
Get off the sidelines. So
man.
yeah, that was a
Yeah.
neat conversation. So also we have HSA. So this
Yeah.
is actually something new for me. I hear about it all the time. From time to time. I'm not gonna say all the time. A lot of people don't talk about it, but I hear about it from time to time. And I just recently, did research on it. I'm like, all right, why do people keep saying that they invested in this? Like, what's the point? So, but before I go into that, first I'm going to say that the limits have increased. Last year it was 3,850, and this year is 4,150 for HSA contributions. So before I get into my thoughts on HSA after my due diligence and individual research, Deshaun, I would like to ask you, because you invest in the HSA, right?
Correct. I do.
I would like to ask you your reasons for investing in an HSA. Oh, and HSA means health savings account.
Right. Yep. I was gonna say that as well. Yeah. So HSA is just another form of leveraging the benefits that come associated with like all these different retirement accounts. I look at an HSA, and it might be weird, but I look at an HSA as a retirement account, bro. I'm not gonna lie. So when I look at it, I think this is an account that I'm growing specifically for me, my future family, and any type of health complications or health issues, or just regular doctor visits, dental visits. Health HSA does not expire, not like an FSA that you have to use the money within the year. Your HSA is the contributions are you can write them off. You can deduct your contributions to an HSA. There is no federal taxes when you're using the money. So the amount of money that you're contributing to your HSA
is tax free. We talk about that a lot with your Roth, right? And another thing that people don't know, but you can invest your HSA. It's like my HSA is in my Fidelity account. It's one of the accounts I can look at. If I wanted to, I can take that money and put it into SPY. Take that money, and those gains are also not taxable. So again, I see, and it's not a lot of money, right? The limit is $4,000 for the year. So it's not like I'm putting in 23,000 like my 401k. $4,000 every year, which is not a lot for my paycheck on a biweekly basis. So I'm not missing that money. And I know that in the future, I'm going to need to pull from an account for medical expenses, whether it's like me just needing to go to the dentist. You know what I'm saying? In my future in life, I plan on, wanting and having children. So there's going to be medical expenses that come with that. But with me not having kids now, I've used my HSA to do things like get acupuncture. When I was running for the marathon, I was realizing I was like, okay, cool, I'm having back problems. So I wanted to go get acupuncture. And for months, using my HSA account to pay for that tax free. But again, bro, it's just benefits. It's benefits that you are able to take advantage of, knowing that you're going to use this money for some type of medical reason. It could be prescriptions. It could be, I mean, there's a whole website where you can say all these things you can purchase with your HSA. These are the things you can buy. These are the things you can't buy. Um, and all of the things I mentioned before is tax deductible. You can invest it. Um, no federal taxes. It's all positive. You just got to keep it in that realm of health, which,
Okay.
yeah, which is like, I know that I'm going to use that later. You feel me?
I hear you. I guess with me it's like a not I know that I'm gonna use that factor to it. Like I get if I put maybe like 500 a year in there. You see what I'm saying? Cuz for one, when I get cleanings, it my dentist insurance what dental insurance picks that up. You see what I'm saying? The
Yeah.
only the only reason why I have to pay is when I got my wisdom teeth taken out. But how many times am I going to do that? You get what I'm saying? But yeah, I see what you're saying with prescriptions, but is that going to amount to $4,000 a year? And I guess that's the part that I'm thinking about, like maxing it yearly. Will you ever spend that much money? But one thing I'm sorry.
I was going to say, so I don't think about it as maxing it out to spend that much money in the year. I imagine, and I will say this: I don't max out my HSA. I
Okay.
don't put $4,000, or I guess last year I don't put $3,850 in my HSA. I put max roughly like 1,200
See,
a
this
year.
makes sense. That makes
Yeah, I don't
that
max it out.
that seems like an amount that I would be able to spend. And I know that you said that you were about to say that you don't think about spending it in this year. But if you're
Right.
putting that in every year and you're not spending that much every year, there's going to be a surplus.
Yeah, but the surplus is for the future Deshaun. I mean, I just got engaged, bro. So there is going to be Papa Deshaun soon, and that's going to be medical expenses, and the HSA building that will be put towards those things.
Let me put this on a pause real quick and congratulations, Deshaun, on your engagement, bro.
Appreciate it.
Congratulations,
Appreciate it. Thank you,
Deshaun and Ashley. I should say that at the beginning of the show. My apologies, man. That is huge.
bro.
That's
Thank you,
huge,
man.
man.
I'm super excited, bro. Can't lie to you. That's one
Yeah.
I should have said that when I said, well, my 2024, like that definitely that's a big change for me. You feel me?
Proud of you, man. This is our first episode after Deshaun getting engaged. That's really a dope feat, man. And one of the things that make people feel successful. It's not all about money, man. You see what I'm
Mhm.
saying? Like things like family. And now y'all are about to start a family. You see what I'm
Yeah.
saying? So kudos to you, and I wish great things on y'all, man.
Thank you, man.
Congratulations for sure.
Appreciate it. For real,
All
for
right,
real.
now
But
back to this HSA.
yeah, so yeah, man. When I'm thinking HSA, I'm like, man, the plan is to, multiply. And as I do that, I am going to have this tax-free money,
I get it.
this
I get
already written off deductible. Yeah, but again, I'm not maxing it out now. I am
I
putting 1,200 roughly a year into that,
and I
and
get
I
that
barely use that. You feel me?
and I get that you're going to have children, but also are your children not going to be on your health insurance? And if somebody can fill me in better on this, like I'd be, like my thing is I'm always going to think. I'm not saying that it's a bad investment. I'm just trying to rationalize it in my head.
No, no,
My
no, for
thing,
sure.
yeah. If
I
your
think
kids,
insurance is great, right?
right,
But lately, insurance has been, I don't know, it's been messing people over, bro. Like they haven't been like they'll either not pay, or you always have the deductible that you have to pay for most people, which is going to be between like 500 or 250, whatever the number is that you got to pay that deductible before your insurance kicks in. Um, and then a lot of times insurance companies can just say no. They'll be like, nah, I don't think that this qualifies as a blase blah, or you got to read the fine print with your insurance. And I'm talking about insurance holistically. I haven't had to dive into my health insurance all that much because I don't go to the doctor, I go regularly, but I don't have to go a lot. I don't have to go to the doctor a lot. So it's mainly I go to the dentist, get a cleaning, pay for insurance. I need to get a refill on my albuterol insurance, but that's like I'll do my yearly
physical
physical
insurance.
insurance. But besides that, I haven't had I haven't had any huge medical complications, knocking on wood. So I haven't had a huge reason to use my health insurance. Um, but I do pay for it. And then this is just for those times when if health insurance decides not to cover something, or if I have additional deductibles that I need to pay, or if I'm just purchasing, because I mean, you don't have to just use your HSA to go to the doctor. It could be like you purchasing something from the store, like medicine or something. That can be health insurance as well. But again, it's not a humongous amount that I'm putting into my HSA right now. It's just enough to where if I need to go and purchase something for the year, I can pay for it with tax-free money. Like that is the best benefit right now. I haven't even dove into investing my HSA into anything yet because again, the gains that you get from investing are also tax-free. Like that's not.
Yeah.
But again, your HSA just has to be used towards medical. Go ahead.
And I did see something positive about HSA because I was like, man, what if you don't use it for this? But what I realized is when you hit 65, you can use it like a retirement account. You can actually start withdrawing from your HSA, but
Penalty
you
free.
get penalty free, but not tax free. You'll be
Oh, okay,
taxed
okay.
at your right, so that
Hmm.
tax benefit will not be there.
Got you, got you. But still,
So it works like a traditional IRA, basically,
exactly. Yeah, yeah.
which is pretty dope,
Hmm.
right?
Yeah. So just some of the benefits of HSA. I mean, it's not for everyone. If you feel like that 4,150 or whatever the amount you put into your HSA can go better towards a 401k or an IRA, or if you're not using it specifically for health benefits or health reasons. I mean, everything we talked about, all of it has its own specific benefit. HSA is just for, you get the benefit most when you're using it for medical expenses. Because like you just said, Cornell, you can't touch it really until you turn 65, which
65.
then the tax benefits aren't even there. And I think you can withdraw from an HSA whenever you want, but there's a huge you get hit, I think like 20% on the amount of money you pull out. So it's just like don't touch it, bro.
Yeah,
If you're gonna use it, use it for the medical reasons. Um yeah, so
for sure.
yeah, that's some of the benefits of the HSA.
Yeah.
And why I use one, why I grow mine,
Right. And I appreciate your insight on that. And thanks for
Mhm.
yeah, because you definitely put some things into perspective.
Yeah,
And also while talking about these changes, we definitely have to talk about tax brackets.
yeah.
Because
Tax. This is a confusing topic. Go ahead. Go ahead. Go ahead. Go
it
ahead.
it is, man, and I hope that we get into all of that. So when it comes to tax brackets, I'll start from the bottom and then go to the top. You were taxed 12% for incomes over 11,600. So if you make under 11,600, you're taxed at 10%, right? Anything over 11,600, you're taxed at 12%. All right. And if you're married, you can make up to 23,200 and you'll be taxed at 12%. So the next bracket, 22% for incomes over 47,150. If you're married, 22% for incomes over 94,300. That's if you're filing jointly. The next one, 24% for incomes over 100,525. For married couples, 201,050. The next one up, 32% for incomes over 191,950. For married couples, is 383,900. Next one is 35% for incomes over 243,725. For married couples, is 487,450. And for the top tax bracket, you get taxed at 37% for incomes greater than 609,350. For married couples, it's 731,200. And
That
one
is,
thing that I noticed while reading this,
yeah,
um, when it comes to married, being single and married, it kind of narrows down. No, it's just for the last one. The last one kind of narrows down. I don't know if you noticed, but for single, is if you make 609,000, and if you're married, it's 731,000. Where while the other ones are almost doubled for when you're married. So that kind of narrows down. Yeah.
oh, I see what you're saying.
Yeah.
Yeah, yeah, literally, yeah, it pretty much doubles all the way up until that 37%.
Right.
Man,
But yeah, you're definitely right. This is a confusing topic that we definitely need to hit on. So why do
yeah.
you feel like this confusing?
So my thing is, I don't know if it's do they. So say you make, for example, you set the cutoff for 32%. If you fall in the 32% tax bracket,
Right.
uh, you have to be making 191,000, right?
Anything over 191.
Anything over 191,000 gets taxed at 32%.
Right.
Does that mean, like, say for example, I'm making $200,000?
Right.
Does that mean my first $190,000 is taxed at, well, my first 47,000 is taxed at 22%. Then my next, that goes from 47 to 100, taxed at 24%, and then the
Yes.
rest taxed at 32%.
Exactly, and that's what people don't understand is layered. So it's not like, oh, I
Yeah,
make 200,000, everything's going to be taxed at 32%. That's not
right.
how this works. Okay,
Okay, okay,
so
okay.
so the first 11,600 is going to be taxed at 10%. The next between that up to 47,000 is going to be taxed at 12%. And then up to 100,000, that's going to be taxed at 22%. You see what I'm saying? So it's layered. So people
Yeah.
will say, and this is like one of my biggest pet
I
peeves,
know what
man.
you're
They'll
gonna say.
they'll be like, "Oh, I don't want to. Hey, don't make all that because you're gonna get taxed." Everything we do is gonna get. That's that's like people saying, "Oh, don't make $100 because they're gonna take $30 of it." But you still made $70. You get what I'm saying? You're still up.
Yeah,
It doesn't matter how
yeah,
much money you make. You're gonna be up. You're
right.
gonna be up. They're like, "Oh,
They
that's gonna
they
put you in a
they
different
almost
tax bracket."
promote not making money to avoid losing the money that you made, but you're not making, like, it doesn't make sense to me.
It
Yeah, I
doesn't.
don't get it. They'll be like, "Don't you do all that? You know you're gonna get taxed on that." Like, And if I don't make it, then I'm not gonna get taxed on money that I don't make. Like, make it make sense to me, please, because I don't get it, bro. Um, and I think one of the things that people should say instead is, if you're gonna make all that money, try and find a way to decrease your AGI so that you don't get taxed on all of the profit that you made the previous year. That's way different than saying don't make that amount, don't make that much money because you're going to get taxed higher. Like, make that much money, find a way to, either whether it's through itemization, starting a business, whatever you want to do. But, there are ways to decrease your adjustable gross. Is it adjustable or adjusted gross income? Adjusted gross income.
Adjusted, right.
Adjusted gross income.
Right, man. And this is how the rich play the game, man. So
Really?
what they do is they try to, on paper, they want to make it the least amount possible because that's how much they're getting taxed on. They want to keep their taxable income low. That's why they're keeping their money in these assets. That's why they're writing down all these deductions and yeah, it's a
And
game.
that's literally all the stuff we were talking about. So that means, I wonder if we were talking about the traditional earlier. I wonder if the same applies for that. Is it layered? Is it the first 77,000 you can write off, or is it just once you make this much money
Then you
gross, you can't?
then you
You just, yeah, you feel me?
oh, I feel you.
So, like, will
That,
you always be able to use that benefit of traditional for that first 70? Well, you said 78,000, and then after that, you don't get to write anything else off. But can you write off that first amount every year? Bro, we gotta have a part two to this episode, man.
hold on, no, no,
Oh, okay,
because
it's not it.
It's an IRA. So if you put, it's either you can do it or not. You can only put 7,000 in there. You get what I'm
Oh yeah,
saying?
yeah. You're right. You're right.
You can
Yeah.
only put
Okay.
7,000 in there. So yeah, nah. I think it's just if you make a certain amount, you can't deduct that from your income.
Got you. All right. So then scratch that. Yeah, it does. That's not layered like how the tax brackets are layered. So, um, but nah, man, like that's, and then people complain a lot about how celebrities or how people who make a lot of money don't pay any taxes, but they just know how to adjust their income to where they
They
don't pay taxes. Go
Yeah,
ahead.
they hire somebody that knows how to do it. They pay good money for a good accountant that
Mm-hmm.
that puts them in a great position. So it's something that we need to think about. A lot of people, I've met a lot of people that don't understand their taxes. They feel like it's a lot of people with just a W-2 that feel like going to a certain person is going to change their taxes. And if you don't really have much going on and you just have a W-2, it kind of is what it is.
The numbers are
So
the numbers.
the
Yeah.
numbers are the numbers. I know people be like, "Oh, I'm gonna go to her because she got me 10,000." Like, it's, I don't know. And then some of these people
Watch
do
out for
some.
them, man. Don't, I mean, God forbid something like an audit comes around and you somehow magically made 10, 12, $15,000 in your taxes, and yeah, just because there are certain deductions you can use, but you got to make sure that you actually fit into those deductions, because whatever you put on your taxes, that's just gonna come out, but that doesn't mean that it's right. It doesn't mean that it's correct.
Exactly.
So yeah, make sure that you also do your due diligence when it
Man,
comes to the people that you're working with your taxes. Go ahead.
I had a friend, man. He has a job and he was doing DoorDash. And then somehow we got in a conversation. I don't even remember how we got in a conversation about his taxes. But he said that he doesn't put in his DoorDash form because it makes his money, his return go down. And I'm like, bro, that's not how that works,
You
man.
can't just not. That's called tax evasion, bro.
See, people look at W-2s as like a golden ticket that just gets you free money. And it doesn't work like that. W-2s don't just give you free money. So what you get back is determined by how much you're paying in taxes throughout the year. If you're getting
Yeah.
money back, that means you overpaid. That
Yes.
means you're paying too much in taxes.
Man, look, I think, bro, we got to talk more about this because and it's a lot with our community. We look forward to, or at least we we look forward to the tax return month, the tax return year, not even realizing that this is money again, like you said, that should have been ours to begin with. We
It's
paid
money.
too much in taxes, and they're giving us the money back.
It's their
And
money.
it's something about that, whatever, a couple thousand, whatever you get back, $10,000, that makes people feel so good without even realizing, dang, this is money that
It's your
I could
money.
have had last year. I just didn't do my taxes right, or whatever the case may be, or however you set up your W-2. So go
It's
ahead.
definitely in our community, man. We're not educated about it, and it seems so normal for like I thought it was normal. It's like, okay, yeah, I'm supposed to get taxes back. No, but when I actually thought about it and figured out what it was that was going on, now I pay them. I make sure that I'm getting my money throughout the year, and I pay them in April.
Right.
I'm not gonna sit here and wait for my money when
Yeah.
when I could have had it from the beginning. For what?
Right. So
For what?
realistically, the goal is to have it zero out in April, or
I
like you said,
I
pay
don't
them
zero.
back.
I pay
Right.
them. I make sure that I'm getting it. I pay them.
Right. You
Yeah,
want
I
to
don't zero
avoid
out.
like exactly. Like
I'm gonna borrow
when
their
you get
money.
when
I'm
you're
gonna borrow
getting a
their
tax
money.
facts, facts. You getting a tax refund mean you paid too much money the previous year, basically, and they're just paying you back. Um, but yeah, man, yeah. Growing up, that's what we always thought was like Christmas number two. Oh, we got a tax refund coming. Bet. That's just money that they owe you or that they owe us. You feel me?
Yeah.
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 Um,
So
Definitely a deeper conversation needs to be had about that because I think there's a lot of miseducation with taxes, and I mean it's warranted. Taxes are complicated. It's not it's not a simple tool.
I,
It I know what you're about to say. You
I
probably
feel
like it's
like
not it's not that.
holistically, taxes
Yeah,
are complicated.
right,
Holistically, but
right.
certain things like you overpaying, that's not complicated. It
Facts,
just hasn't
facts.
been taught.
Your taxes can become more complicated the more assets you acquire, the more you're putting money into different securities, different bodies of money. Like if you're putting money into your 401k, your IRA, you can deduct these. If you're putting money into an HSA, you can deduct that. If you started an LLC and you have business purchases, you can deduct that. If you had losses in the stock market, you can deduct that. There are a lot of different intricacies when it comes to when it comes to taxes. But if you're going to work, getting a paycheck, receiving a W-2, and that's the only thing you're submitting, like you said, it's not that complicated. It's
Get turbo.
simply this is how much money I made last year. Here you go. How much money do I owe? How much money am I getting back? And that's another thing that you would also need to look at is you can adjust the amount of money that you receive each paycheck to say how much you want to put towards your taxes.
Yeah,
And that's a conversation with you and your employer. But yeah,
it's
you could there's like a number tick. I think it's like 0 or 1, and that might I think it's something like that, right?
you don't even have to have a conversation. Just get a W-4 form, fill it out, and give it to HR, and they'll
There
take
you go.
care of it. You don't even have to
There
converse
you
with
go.
them. It's like, yeah, they don't care. This
They
is
don't
why
care.
people have to do their own research,
Yeah.
figure out what they're doing, and do what you need to do to set
Yeah.
yourself up financially.
Yeah.
Yeah, and with that, I know because I know we're nearing the end. We have. I want to just talk about the standard deduction.
Yeah.
So basically, every year they give you an amount that they're just giving you, right? In deductions. It doesn't matter what you bought, what you didn't buy. It doesn't matter. They're saying, hey, you can deduct this from your taxable income. Remember, deductions are good because the less income that you have that can be taxed, the less you're spending in taxes, right?
Hmm.
So a standard deduction is a specific dollar amount that reduces the amount uh, of your income that's being taxed. And this year, the standard deduction, do you have that? If not, I can figure it out.
Nah, I don't have it over here.
All right. Well, this year the standard deduction is 14,600. Okay, so this is the amount that you can automatically just deduct from your income. And if you have, say, you have a business or something, and you have more deductions than 14,600, this is when you would start itemizing and putting things on your Schedule C in order to lower your gross income.
Yep. So, like Cornell said, man, this 14,600 is an important number because this is the number that will either, put you in that I can still contribute to my IRA, put
Mhm.
you in that how much you can um how much you can contribute to your 401k, because all of these, again, it's based off of your adjusted gross income. These contribution limits that we talked about before, not all of them, but especially with the Roth IRA, if you're over a certain amount of money, AGI, then you can't contribute. So if you made this much money last year, your adjusted gross income is exactly $150,000. Your standard deduction will put you below that, allowing you to contribute to a Roth IRA. Deductions are important. They can benefit you in a lot of ways. So make sure that you're looking at that number, that 14,600, if you don't have a lot of other expenses such as business expenses and things like that. So and this is again an increase because they know that times are getting harder. They want people to, or they're allowing people to deduct more money to lower their AGI even further, so they can get some of these different retirement account benefits and things of that nature.
Right.
Yeah, but I mean, this has been a good episode, bro. I think
Yeah.
starting 2024, all of these changes are in effect now. Like they started January 1st. If there was something that you want to go back and look at, just rewind it, rewind the episode, because we talked about a lot. We talked about 401ks, IRAs, traditional Roth. We talked about HSAs. We talked about the different tax brackets. It's a lot of information in this episode. So if you need to go back and re-watch it, please do. But we wanted to make sure that we hit y'all at the top of the year with all of this information, because this is where you start to do your wealth planning. This is where you start to plan out how you're going to distribute your money throughout the year. So look at all of these different ventures, all these different avenues, all these different accounts that you can put your money in to start building your wealth. It's important that you understand these numbers. So 2024 has basically overall across the board increased the limit in each of these accounts,
For sure.
ultimately. Mm-hmm.
And there was one announcement that I missed at the beginning of the episode. New Investors Playbook merch is on the website. Okay, and that website is www.investorsplaybookllc.com. Check it out. The stuff is dope. You'll like it. And yeah,
Yeah.
we have clothing, we have shirts, hoodies, and we also have coffee mugs.
Look, I need to upgrade.
Yeah, you got to upgrade, man. You got to get that Investors Playbook for sure.
Yeah.
So yeah, so can you tell us? Well, can you tell the people where they can
Mm-hmm.
find us?
Absolutely. So, website, of course, as Cornell mentioned, investorsplaybookllc.com. This is going to be our Instagram at Investors Playbook LLC, our YouTube at Investors Playbook LLC. You can find episodes like this on Spotify, on Apple Podcasts, on Audible. You can find our book on Amazon.com. You can type in either Investors Playbook Volume 1, 6-Step Process to Financial Freedom, or easier ways to just type Deshawn Edwards or Cornell Rowan. We are authors now. So if you type in our name, our product will pop up. That's available in paperback, ebook, and now audiobook. So you can find us on a lot of different platforms. But ultimately, if you are listening to this episode and you listen to the entirety of it, because this is a long one, we appreciate your support. I think this is our longest episode, bro.
It is.
We
Thank you,
appreciate
thank you,
your
thank you.
support, man. Like it means a lot. Coming from being a business owner, seeing the steady growth of people being interested in something that you truly believe in, which for us is financial education and financial literacy. Like, it means a lot. We don't just say this like to bait people. Like, we actually want people to learn as much as they can about this, because these topics are very important and they're always going to be important. They've always been important. The problem was, we people in our community, people, or in our circle, we just didn't talk about it. So we're trying to, change all that. We want people to learn as much as they can about finances, learn all the what we used to call secrets. They're not secrets. It's just a lack of knowledge, a lack of financial literacy, and it's very important to Investors Playbook, and it just means a lot that we're constantly getting the support and it's growing. So thank you again for all the support. Cornell, you want to say anything before we conclude the episode?
As you said, it's important, man. The thing is, it's not just dumb information like you know some things on the internet are. This is stuff that will change your life if you
Yeah,
let it, and you have to be intentional. So yeah,
literally.
well said, man.
Appreciate it. All right, man. Well, another episode in the books. We will catch y'all next week.
Yeah, episode 19. Peace.
Peace out.